Under a dim London sky in 1956, the British pound didn't fall with a bang. It bled out quietly. The newspapers called it a diplomatic crisis. Traders called it a currency shock. But inside the Bank of England, officials whispered a different word: humiliation. Because for the first time in modern history, the world watched what happens when a superpower realizes to late that money, not missiles, decides who rules and who kneels. Fast forward to 2027, and the question hanging over Washington sounds uncomfortably familiar. What happens when a currency that built an empire suddenly can pay for one? If that sounds dramatic, good, it should, because the dollar's dominance has never been about green paper and metal coins. It's about control, access, obedience, and like every empire before it, control lasts until the bill comes due. Why talk about this now? Because for the first time in half a century, there are credible scenarios, quiet ones, not Hollywood collapse scenes where the dollar doesn't die violently, but simply loses the power once wielded effortlessly. The world keeps turning. Markets stay open, planes still fly. But one day, the United States wakes up and realizes it can no longer force the price of oil, debt, or war in its own currency. And at that moment, the 1956 pattern repeats. Let's set the scene simply. Britain in the 1950s still believed it was running the world. The empire was gone, but the swagger remained. The lesson is so simple it almost sounds childish. The world reserve currency is only the reserve currency as long as the world believes the issuer can pay for its promises. Once that belief cracks, power evaporates faster than gold leaves a vault. Now, fast forward 70 years, America is no declining colonial relic. But the math is starting to rhyme, and markets have a long memory. Start with the numbers. In 2001, America's debt-to-GDP ratio was about 55%, manageable. By 2020, it hit 129%. In 2024, the Congressional Budget Office quietly projected a path toward 150%. By 2027, assuming no major cuts and normal recession cycles, analysts estimate 165 to 175%. In English, Washington is borrowing tomorrow's empire with today's credit card. Debt is not an apocalypse. Japan's number is worse. But Japan doesn't run the global reserve currency. Japan doesn't have to police oil lanes in the Persian Gulf, fund military alliances, backstop a global banking system, and bail out its tech sector at the same time. Japan can hide, America cannot. Here's the uncomfortable math no politician likes to say out loud. The dollar is strong because foreigners must hold dollars to trade. If that structural demand weakens even 15 to 20%, Treasury auctions start getting awkward. And if Treasury auctions get awkward, interest rates must rise not to fight inflation, but simply to lure buyers. Higher rates mean higher deficits. Higher deficits mean more debt. More debt means more money creation to cover the difference. Congratulations, you've entered the feedback loop that every empire with a reserve currency eventually faces. This is where the 1956 pattern kicks in. Because Britain didn't collapse when the pound lost reserve status. British markets didn't crash. There was no zombie apocalypse. What happened was far more humiliating and far more permanent. London could no longer finance its foreign ambitions at discount rates. The empire didn't fall, it simply became unaffordable. That's the real threat for the dollar. Not hyperinflation, not Weimar wheelbarrows. Just a quiet moment in a treasury office where someone whispers, "We can defund this at 3% anymore." Now, before this gets too fatalistic, let's zoom out. What makes the dollar today? 3 pillars. First, commodity pricing, especially oil. Second, trade settlement networks. Third, U.S. Treasury markets, also known as the place where global savings go to feel safe. Pillar 1 is weakening. China buys Saudi oil in yuan. India trades Russian crude in dirhams. The BRICS bloc tries to clear transactions without touching New York. In 2000, over 80% of global oil was priced explicitly in dollars. By 2026, analysts estimate that number could drop below 60%. Still dominant, but dominance is not invincibility. Pillar 2 is shifting. The SWIFT system worked as long as it was neutral plumbing. Then geopolitics weaponized it. Russia got cut out. Iran got cut out. China built SIPs. India built its own platform. These aren't replacements yet, but they're insurance policies. And people only buy insurance for one reason: they don't trust the future. Pillar 3, the treasury market, is the big one. In 2010, foreign buyers held 34% of U.S. debt. Today, it's roughly 23%. By 2027, some forecasts put it under 18%. That difference, in just numbers. It's a question: who will buy trillions of new U.S. bonds once the foreigners stop? The answer is simple, and also absurd. The beer of last resort will be the same institution that prints the currency. It's elegant, it's circular, and it works until it doesn't. Now here's the part the internet gets wrong. De-dollarization isn't a coup. It's not dramatic. No country announces it on television. It's a slow migration of habits. A Saudi trade desk moves 12% of contracts to yuan. A Brazilian firm invoices exports in euros. An Indian refinery settles oil in rupees. None of these moments matter alone. Together, they are how reserve currencies die, one invoice at a time. And while this shift happens, America continues behaving like Britain in the 1950s, convinced that military force and diplomatic influence are still backed by financial leverage that quietly erodes every quarter. This is where irony enters the story. Washington can't stop the dollarization, but it can speed it up. Sanctions policy is the perfect example. Every time the dollar is used as a stick, the world builds another carrot elsewhere. Not because they love China or Russia, but because money hates friction and despises permission. If you want to understand how a currency loses power, focus less on its enemies and more on its friends. Britain didn't lose the empire to the Soviets. It lost it because its closest ally America decided the pound was no longer essential. The day Saudi Arabia prices half its oil in yuan or euros is the moment the dollar isn't threatened by rivals, but abandoned by clients. Let's pause and address the obvious. Is the dollar going to collapse in 2027? No, that's not the scenario. The real risk is that 2027 marks the year the dollar stops being the default. The year central banks stop reflexively buying treasuries. The year trade desks stop assuming oil equals dollars. The year America realizes that running a global currency a blessing until suddenly it's a bill. And there's a darker implication. The United States is still the strongest power on earth, but power without cheap money is expensive power. When Britain lost discount financing, it didn't lose the Royal Navy, it just couldn't afford to deploy it everywhere. The map shrank, the ambitions cooled, the myth ended. Now imagine an America that must choose: Pacific or Europe, Middle East or domestic spending, military modernization or social programs. Every empire eventually faces this fork. The Greeks did, the Romans did, the Ottomans did, the British did. Reserve currencies let you delay the fork, they do not let you avoid it. So, what happens next? That's the curious part. If the dollar truly enters its post-imperial phase, America becomes more normal. Imports cost more, deficits matter again, wars get priced. Diplomacy requires concessions, and Wall Street no longer dictates terms to emerging markets. In a strange way, it might even make America stronger at home and weaker abroad. But here's the unresolved question that no economist can answer cleanly. Does the United States willingly accept a smaller financial empire? Or does it demand the world keep paying for one? That decision determines whether 2027 is remembered like 1956, a quiet, humiliating turning point, or something far more disruptive. Because currencies don't die when people stop believing in them. They die when the issuer refuses to believe the world has moved on. Thanks for watching, and if you found this perspective valuable, be sure to subscribe for more.